Chapter 2: Lines of Credit and Business Loans. Business loans and lines of credit are two of the most conventional ways to fund a new venture. The beautiful thing about loans is that they come with a plethora of possibilities. Microloans have previously been discussed, but you may also check into short-term financing, long-term financing, loans for development, finance for equipment. Keep in mind that certain business loans may be more difficult to qualify for than others, particularly if your company is fresh new. Furthermore, you may have a more difficult time obtaining a term loan from a bank, while an internet lender may be more flexible in providing finance to new enterprises. A company line of credit may be simpler to get, but it operates differently than a loan. A loan provides you with a lump amount of money that you may utilize to support your company. The loan is subsequently repaid in accordance with the repayment plan established by the lender. On the other hand, a line of credit might be a revolving credit limit, comparable to a credit card. You use your credit line to make company purchases as required, then refund the balances. As you make monthly payments on your debt, you free up credit that you may utilize for future needs. This may provide greater flexibility when funding a startup, and you only pay interest on the part of your credit line that is being used. Factoring. If you already have some clients and cash flow coming in, factoring may be something to consider when funding a startup. Factoring allows you to borrow money for your firm by leveraging your outstanding accounts receivable. A factoring business makes a loan to you based on the value of your receivables. You may return what you borrow when invoices are paid, or the lender may collect payment immediately from your clients, depending on how the finance firm operates. This sort of small business finance should be considered if your operational experience and credit history do not qualify you for other types of funding. A merchant cash advance or inventory financing is similar in that you don't need to have great financials to qualify, and you don't have to furnish collateral like you would with a traditional loan. The disadvantage is that factoring might be costly, since lenders may levy fees instead of a regular annual percentage rate. The similar APR associated with factoring or any other sort of cash advance lending might wind up being far into the double digits, depending on the amount you borrow and your repayment conditions. Final thought: how to fund a new business. Choosing how to finance a new company may be influenced by a number of variables, including how much money you need, the strength of your credit, and if you are comfortable taking on debt or swapping stock for cash. When considering any of these small business financing solutions, examine the potential return on investment and compare it to the cost. Also, before applying for borrowing, carefully examine your credit ratings. Knowing where you are in terms of credit will help you narrow down which kind of financing is ideal for you. Get your company credit reports, then go to the NAV marketplace to look at funding options.